Hello, everyone. Thank you for joining today's session, No More LIBOR, What's Next for Trade Finance. As a reminder, today's session is being recorded. It will be made available on demand and should be available on the BAFT conference website within 24 hours. Thank you so much for joining us today. I'm pleased to be joined by two esteemed colleagues, Tom Parkman, who's head of research at TXF, and Luka Lightfoot, partner banking and finance with Baker and McKenzie. I cannot stress enough the importance of today's topic, No More LIBOR. As we have heard in the headlines for several years, the cessation of LIBOR is upon us. The significance of this for the trade finance business cannot be overstated. Given the importance of LIBOR as a reference rate for a broad array of trade finance products, getting the transition right will be critical. And the transition indeed will differ significantly across various currencies. We at BAFT have been tracking this transition for several years now. We've assembled an expert working group that convenes on a regular basis to discuss new developments across various currencies, to advocate on behalf of the trade finance business, and to provide market education to our members. We're pleased to have this partnership with TXF and Baker and McKenzie, where we've co-produced a research study of financial institutions and corporate clients about the significance of LIBOR's transition for the trade finance business. This research that we're about to unveil today will hopefully provide some guidance and some real-time information about what banks are thinking about the transition and what your corporate clients are expecting as we move from now through the next 6-7 months before LIBOR ceases. I am going to shortly pass this presentation on to Tom Parkman, who led the research of this project, but we'll note that, like any research study, the information that is contained within this report provides a snapshot in time. The LIBOR transition is quickly evolving. In fact, many new developments have arisen just this week on the USD front. Nevertheless, the information that we glean from this survey will be instrumental in preparing for the transition, will help guide our efforts at BAFT as we help you prepare for this transition, and certainly is a great piece of information and content for all of you listening. So thank you once again for joining us today. I am going to hand it over to my colleague, Tom. Thank you so much for your leadership on this front, Tom, and look forward to hearing more about what the respondents stated. So over to you, Tom.
Thank you, Diana, and welcome everyone. Thank you for joining this session. It is a really important subject, and Luka, myself, and Diana have spoke at length for the last several months about how best to shape this report. And as Diana absolutely rightly mentioned, it's such a fluid landscape and it's always changing, and we will make sure that this report is as up to date as possible when it comes out. But it is important to remember that the data I'm about to show you was done earlier this year, a couple of months ago. So it's just important to bear that in mind. Before we go into sort of some of the findings, I'll just give you a breakdown of what we did. So we conducted a survey with banks and with corporates, and we did it online between February and May 2021. And we ended up collecting data from 136 individual respondents. So what that means is that's 136 individual organizations. There's no duplicate data in there. So if we had more than one respondent from, say, a bank or a corporate, we aggregated the data and then averaged it. The reason that we do that is so then everyone is treated as one, and there's no bias in favor of, say, the largest corporates or the largest banks. So there's no bias in the report. What we also do is when we collect the data, the survey data is really important, to identify the trends, but to understand why and how some of these trends are occurring, we conduct structured interviews as well. So what that means is we go back out to the respondents and just ask them for more context, more detail as to why they think some of these survey trends have occurred, and it gives you more detailed insights. And for the I will be presenting some of the quotes, and the report is a really nice mix of survey data mixed with qualitative insights as well, which gives you the how and the why. So to give you an idea of the people who responded, so we had a relatively even split of banks and corporates, and which was encouraging. So there's a decent sample size within each, which allowed us to do more bespoke data cuts. You can see that most of the respondents, nearly 2/3, were identified as either a senior level or a global head or a director. And unsurprisingly, you can see that USD and Euro were the two heavy currencies being used. And interestingly, one part of the, we discuss in the report that was, of course, USD and Euro. So we're looking at SOFR there, and then the different types of Euro-based RFRs coming into play. We discuss as well, what about some of the other currencies? What about Japanese yen, for example? What about Islamic financing? And we do go into much more detail on that. But it's unsurprising that USD and Euro featured so heavily amongst the respondent types. In terms of where the companies were headquartered, nearly 2/3 in Europe. Again, I think this reflects the relatively Eurocentric nature of trade finance. A lot of the biggest companies have got headquarters there. The biggest banks certainly do, and a lot of the corporates who took part they have headquarters there. But the important thing is that they all used different currencies, and that's the important point here. So whilst it might be the respondent types are Eurocentric, because we're talking about currencies like USD, Euro, and to a slightly lesser extent Japanese yen and the British sterling, we have a really good understanding within the report of the implications for the different types of currencies in use. So the next few slides, what we're going to look at is data specifically from the corporates. Now, what we did in the report, and the report is freely available and hopefully coming out soon, we delved into what the corporates think and what the banks think, and where applicable, we combined it. Now, what the report doesn't do is sort of go over a lot of what's already been said. Yes, we do draw on literature. For example, like Diana said, there was literature always coming out all the time. And of course we do draw on that. But what we really wanted to focus on was particularly around the practicalities. Where are people at the minute? Where are the corporates? What sort of information are they getting? What sort of correspondence are they having from their banks? How important do they perceive it? And then similarly, the slightly later part of the presentation, we do go into what the banks think, how they're engaging with their clients, what they think of trade finance, and where they trade finance currently sits in the priorities of Libor, for example. So the first few slides on the corporates. So you can see here, so one of the questions we asked was just how important is the concept of like Libor transition or Libor cessation? And you can see from figure 5 that it is, at the minute, it was reported as below Brexit and below COVID-19. And if we go to one of the quotes, a corporate in Europe said, "We know Libor is important and we do have exposure to it within our loans, but honestly, tackling the fallout of COVID-19 is more pressing to us at the moment." And I think that's an important point to make, because the key thing here is it's not to say that Libor isn't important. It's just to say that with the year that we've had, and particularly from a UK perspective with Brexit, it has just fallen slightly below in the pecking order. And I just want to bring in Luka here, because from a legal perspective, what are you seeing in terms of the people that you engage with or your clients that you engage with, and why do you think this data perhaps has come out in the way it has?
Yeah, thank you very much, Tom. I think the data has come out in this way because COVID and Brexit are very sort of immediate or very sort of short-term impact on business and on corporates. Whereas I think the Libor discontinuation and a move towards risk-free rates was always perceived to be a bank problem and was regulatory driven. And although banks have been thinking about risk-free rates and the discontinuation of Libor and the other of Libor, it is something that corporates are only starting to get up to speed with and are being asked about and are being talked to. And obviously we'll cover this as in the other slides, but of course there is then a sort of perception of what are you going to talk to them about and what are you going to say when you do that.
So do you think if we did this again in, say, a year's time, we might get different findings here, slightly further away from COVID, in theory, slightly further away from Brexit? Do you think this might change? I mean, obviously, I know you're speculating, so we're not going to hold you to that, but just interesting to see if you think it's a point in time thing or you think it will carry on.
Yeah, it's a very interesting question, Tom. It may well have a different finding, but I think that the Libor discontinuation is going to happen, whether we like it or not. And there are going to be different positions in the market as to what the fallbacks will be and whether we have a term SOFR as your first fallback, and even if that's going to be picked up and approved for use in the market. And in particular for trade finance, it's going to be interesting to see what market participants are going to select as their fallback rates when term SOFR isn't available or is not approved. And that will vary considerably. But I expect that corporates will still consider their immediate challenges the most pressing, whether that be a fallout of COVID or trade, or perhaps, you know, what one might say, digitalization.
Yeah, really good point. And I think that speaks to to figure 6 as well, in terms of the knowledge of LIBOR cessation. It's unsurprising that the banks have a higher knowledge. It's sort of their domain, like Luka really, rightly pointed out, whereas corporates are perhaps trying to catch up. And I think that'll be an interesting, if we were to do this again in a year's time, how that might change. But yeah, really interesting points. And I just want to move on to sort of following on from this. Consequently, it's perhaps not unsurprising, therefore, that more than 2/3 have said that they don't feel prepared for LIBOR cessation. And there were a number of reasons for that, but one that was consistent across the interviews was around term SOFR, which Luka has said. So one corporate noted, there is still a lot of uncertainty what will be the market practice and whether SOFR term rate equivalents will develop ahead of the transition. For corporates who do not have easy access to legal advisors, brokers, or the correct bank staff, it must be very difficult to get clarity on what is happening and what needs to be done. And I think the important point to make here is we also then need to understand the nuance of perhaps the developed markets and the developing markets. I think developed markets where they have access to legal expertise, they have access to banks, they generally just have more resources. Perhaps this is less of an issue, but it's been repeatedly written in documents by the Bank of England, by the Fed, for example, about sort of less sophisticated borrowers in emerging markets. And it's not just around the lack of resources they have, but there are more processes they need to consider. And I think things like, foreign exchange, transactions, if they were going to go from local currency back to, whatever the currency that the deal is done in, they need to get, budgetary, local government approval. And I think whilst these aren't new, they just add that extra layer of complexity that the borrowers in developing markets really need to consider that perhaps developed markets perhaps don't. Moving on to figure 8, you can see perhaps why then it's unsurprising that derivatives, for the respondents, they said that the derivatives market, they've made most progress. This is a reflection of the wider market. It's unsurprising. I mean, if you just look at the is the fallback language that came out earlier in the year, whilst there may, it's generally agreed universally that there is suitable fallback language about what is going to happen in the derivatives swaps market, for example. But if we look at trade finance, syndicated loans, cash products, it is more tricky. Tough legacy loans, for example, the lack of fallback language, and also the lack of consensus around the spread adjustment. And I think for those, that therefore consequently in trade finance, it is going to be more of a problem going forward, and therefore it's even compounded for borrowers in emerging markets when they have to deal with these sorts of issues as well. Moving on to this side, so this was perhaps the most interesting slide for me about the types of support. So figure 9 shows that how often they were receiving support, and generally speaking, that the corporates are relatively pleased or relatively happy with how often they're receiving the support. But as the quote suggests, I'll just read it out. It said, "The type and quality of the support we have received has been poor. I've mainly received general notification emails. In the meantime, I've educated myself on LIBOR cessation. We've performed a scan throughout the company and developed our own route map." That seems relatively extreme, but that wasn't uncommon. A lot of the corporates have said that they've not had support from the banks. And the support they have had has generally been through things like emails and not through things like detailed white papers or reports. And as you can see in figure 10, there's a disparity between the level of support that the banks think they're providing compared to what the corporates are receiving. And this was a really interesting point. I want to bring Diana and Luka back in on this, because I think you both offer some really interesting insights. So Diana, if we come to you first, I mean, you've got quite a unique perspective because you're from an association point of view. What are you seeing when you engage with the banks, when you speak to the banks? Is this the sort of view that you're getting, or are you seeing something different?
Yeah, thanks, Tom. I think even with the quote that was in the prior slide, I think much of the uncertainty that perhaps some of the corporates were reflecting was uncertainty that was present in the market for banks themselves. as kind of this slide illustrates, much of the communication has been general, in large part because the path forward was not clear. Even in the prior quote referencing the availability of SOFR when or if that would be the chosen alternative, we within the BAFT working group had spent a lot of time, I would say specifically during the time that this survey was conducted, thinking about alternatives to a SOFR term rate in the event that one was not made available. So I would say part of the communication challenge for our member institutions over the past several months had been being able to articulate a clear path forward. And I think that we are now closer to that point. I also think that there is an opportunity for industry associations such as ourselves to provide some of that messaging or content that can then be used for banks of all sizes within our membership community to leverage that and to share that with corporate clients as well once there is a market best practice made available. And that's something that we're working towards. I will note that especially since the topic of kind of availability of term SOFR is kind of one that was kind of key for many of the survey respondents, just wanted to make sure that those in the audience are aware that there have been some regulatory and some policymaker indicators that emerged just earlier this week. Last month, the ARC, which is the private sector advisory body that advises the Fed on kind of the USD transition to SOFR, published some new guidance about when we could expect that the ARC would recommend a term rate. One of those key milestones was for there to be sufficient underlying transactions within the SOFR market. And just earlier this week, they announced that the 26th of July would be the date that they would set as a best practice for brokers to change USD linear swaps trading from USD Libor to SOFR. A similar switch occurred in the SONIA market that was really seen as the key trigger point for volumes to increase and ultimately for the Bank of England to recommend a term SONIA reference rate. So given some comments by the ARC's chair, Tom Whiff, that an announcement would come shortly after that July 26th date, I think we can see that there is some positive progress. And there are also other alternatives to SOFR that have emerged. So all this to say that understand where the corporates were coming in terms of a perceived lack of information. And I think that will quickly change as the industry organizes itself around some best practices, and that's really a role that BAFT can play in helping to drive some of that.
I agree completely, and I think it gives a really interesting. I mean, it has literally information come out. It does feel like an almost weekly basis that information is coming out. It's such a fluid thing, isn't it? Changing. And Luka, I just want to come to you because obviously, so you're in a unique position, I think, from a lawyer's perspective, because I imagine drafting the contracts and the facility agreements, etc. You get to see sort of everything, both sides. Okay. So, I mean, from your perspective, I mean, what do you think of this data? What shouts that, what comes from you?
Yeah, thank you, Tom. Perhaps to pick, I think there are 3 or 4 points here. One which Diana mentioned, which is a very good point. It's around sort of a lack of best practice or a market standard, and when you sort of approach someone to talk about, hey, a risk-free rate for Libor, US dollar Libor, it's very difficult to speak about that without having a best practice, and therefore, we can certainly see how it can be challenging to speak to clients about what should we be doing. I think the second point is one where advising on a particular fallback rate or risk-free rate sort of may be perceived or sort of walks a thin line to giving sort of financial advice, which in itself is a regulated activity. And therefore, I suspect that a number of bankers are quite acutely aware of that and sort of cannot really advise which rate will give you the lower outcome, so to speak. And then I think the third question is more of a question around, what do corporates consider to be quote unquote support? Because Yeah, there, as we see from Figure 9, that there is quite a bit of communication with corporates, at least monthly and quarterly. Perhaps that should be increasing, but support could also be construed as, you know, who will have to pay for these changes, and how do we address them? And I think that is one of the sort of, you know, the elephants in the room for the corporates around, well, I've got to change my documentation, but you're not telling me what to change it to, and you're not telling me you know, how much it's going to cost, or who's going to bear the cost for the changes. So I think that's probably, you know, the third thing that I'd add to kind of the perceived lack of support.
I think they're all really important points, and I think because it's like both you mentioned, like the lack of clarity. And I just want to come to the next slide, because I think it speaks nicely to the point you're making. That it's important to state here that the banks are also sort of in a position where there's still that sort of lack of clarity, and they want to be able to provide more. You know, all of the banks said we want to engage with our clients more, but until there is real clarity on what is going on, and that is changing all the time, as you can see from these quotes, it's very difficult for them to do that in any sort of meaningful way. And as the quotes suggest, it's just trying to find that path forward, and in order for them to be able to provide that support. And Diane, I don't know if you want to add anything on these quotes here, but I think the point that you mentioned about associations like BAFT, for example, I think have a really crucial role to play here. And, you know, in the UK, we have the LMA to really push that information out, because I don't know whether it should just be to do with the banks. I think other people need to be getting involved here. And I think BAFT and do a really good job of that, and to provide just more information to people on how we can get through this.
Right. Certainly, Tom. I mean, we've seen it, our role is twofold, primarily to educate, but I would say equally importantly to advocate. Since we founded our working group, our core priority has been to advocate before the ARC the need of a term SOFR. That being said, earlier this year, when the signal from the Fed and the ARC was that one might not be available in time to transition, we quickly pivoted to looking at what other alternatives were on the table. So over the last couple of months, we've brought in other vendors who are providing alternatives to term SOFR, those who are providing credit-sensitive rates in the US dollar market, those such as the Bloomberg BSBY rate, the Ameribor rate, the IHS market rate, and others to brief the group on whether these are indeed viable solutions. While the ARC has made it clear that SOFR is the preferred rate, it has not stated to financial institutions that it is the mandatory rate. Financial institutions are in a position to pick a successor rate that makes the most sense. So while we do, and Luka, as you mentioned, while it is a tight line between kind of providing explicit guidance that signals what rate institutions should use, it is certainly our role to provide that market education. And to that end, one of the deliverables that the working group has produced is a comparison between the expected SOFR term rate that will be live, the CME group's rate, which we forecast that the ARC may recommend by late July or early August, and the other rates that are live, some with varying levels of ready to go, many of the term structures that we're accustomed to within LIBOR, and really to spell out, here are the options for our members, and ultimately this is information that could also be leveraged to have conversations with their corporate clients. Yeah. So for members who are tuning in, please be on the lookout for that. Should be a helpful resource.
Yeah, absolutely. I mean, just to jump in, Tom. I mean, Diana, that's really, you know, fantastic, because it is really showing how the LIBOR discontinuation for US dollars is being tackled, and we are making really good progress with some challenges, of course, ahead, but it is certainly being tackled, and the various options you have mentioned are certainly something participants should be considering, which is great.
Yes, well said, well said. the final few slides, it just focuses on a closer look at the banks. So this is a little bit more specific to trade finance, but it's basically this is based on banking data. So in terms of the sort of the progress made in trade finance, the banks were less optimistic about where trade finance currently is. Now, I don't think, with all the things that we've discussed, the tough legacy contracts, the lack of consensus on the fallback language, etc., perhaps that's not surprising with some people. And as one bank said, for many export finance borrowers, the backwards RFR with a 5-day look back is too restrictive. The export finance industry needs to see if a longer look back period could be determined that could work for both borrowers and the banks. And without getting into sort of the nitty gritty of what the look back period is, Luka, from your perspective, I mean, why do you think this is? I mean, in terms of trade finance, I know we've had conversations sort of away from this about where progress is, but what's your view on it?
Yeah, I mean, I think, with banks sort of saying that the 5-day look back period being too restrictive, one of the options as a fallback to term SOFR, if it is or becomes available, is a longer look back period that sort of provides more visibility. The other options are, of course, looking at a compounding in advance, but we're also perhaps looking at some central bank rates, and the reason some of these rates won't, well, the reason why not every option is suitable to each transaction is because there will be certain requirements, or for example, in export finance to ensure that your cover ratios are met with sort of deliveries of various commodities. There may be requirements to notify your borrowers in advance of what the rate will be, so as to ensure that any cash cover requirements in respect of any reserve accounts are being met. So there won't be an alternative to term SOFR that will work for every transaction, but I think that is a transaction to transaction sort of discussion with the various people around, and then also you have to consider sort of operational readiness. So we've looked at the number of fallback rates or sort of alternatives to what hopefully will become a CME published rate as of which is the SOFR term, but in the US we have a number of other providers potentially as well. So we do need to understand what is the operational readiness of the participants, of the syndicate banks, on a deal by deal basis. So that is another consideration, and it is something that participants are working on quite acutely.
And I think that point goes nicely into the final slide where we look at the greatest challenges for the banks. And we've discussed it, and it's term SOFR rate are at issues, but one thing I wanted to touch on that came out of the qualitative interviews, as Luka sort of said, was around the operational side of things. And one bank said, Libor is ingrained in our operating systems. Changing that in a short space of time will require a monumental effort, and that is just for our bank. I think this is a really, really important point to make, that not just with the lack of clarity or, we're still trying to find the right path, it's then how we implement that going forward. And from your perspective, Diana, with the way that you operate with the banks and your clients, from an association perspective, are they coming to you with any challenges, or are you seeing anything else in the market that you think is a particular challenge?
Sure. So certainly because of the significance of the US dollar, that's been the big elephant in the room, ensuring that moves appropriately and effectively before the deadline. But I would say that we as an industry can't miss transition efforts that are happening in other currencies. While they may be a smaller slice of kind of the trade finance business, they are also occurring. And many of them do not have kind of term rate successor rates that will be made available. Some are moving at different schedules. Oftentimes there's a different approach for kind of home country financial institutions and international financial institutions who are using a rate. So there are lots of other challenges that we need to tackle. While I would say that things are looking to be moving in the right direction, and we certainly feel better, even if we're in a multi-rate environment in the US, which seems possible and quite likely. At least there are distinct paths for the industry to transition in, and I think we will play a role alongside members of our working group to provide some guidance on how to move forward. But we can't miss sight of, I think you mentioned kind of Japanese yen is something that came up in the survey, but certainly we've had a lot of interest in understanding transition issues in Canada. We had a small working group that looked at cessation of a couple of tenors of CDOR in May, something that, you know, was consulted kind of end of the year, perhaps missed by some because it's a smaller currency in the trade business, but certainly has an impact, and we as an industry association have to help guide that and help develop a best practice. So I think over the next 7 months, some other challenges will be kind of figuring out how we transition other currencies, and really how, I guess in this end game and in meeting the best practice transition date, how to get all the system changes in place, and as we discussed earlier in the presentation, how to get the communication right. In US dollar, I think kind of having the right understanding, sharing the right information with clients will be really critical in being able to effectively explain a complex process in a way that makes sense for corporates of all sizes, including those that don't have a treasury function who may need additional handholding, and for whom kind of a general email may not be sufficient. So I think there's still a lot of work for us to do. I think our working group is excited to do that, and can look forward to some additional resources from our part.
Yeah, and there's some really good points there. And Luka, just final word to you before we end. I mean, from your perspective, are you seeing any specific challenges that you know, banks or corporates coming to you with from a legal perspective?
Well, yeah, I mean, Tom, it's the challenges I mentioned around, you know, how do we look at our transactions where we don't have a forward-looking rate, we can't provide for that, and then finding a balance, you know, amongst your club of lenders or your syndicate lenders as to, you know, what will the fallback be if we don't have term SOFR now. The working groups have identified term SOFR as specifically being applicable to trade and export finance. So we do think that hopefully that will provide a somewhat perhaps a silver bullet to the challenge, but you know, that there has not been any approval of a forward-looking term SOFR rate yet. So that's something to come.
Mm-hmm. Thank you very much, guys. I mean, this really is a fascinating subject, and I've just put our contact details there. If anyone watching wants to get in contact with Diana, Luka, we'll hear from you, because it really is a fascinating subject. It's forever changing, and we would love to hear from you. The report is out hopefully within the next week or two, and it is free to download, and we'd love you guys to read it, to ingest it, to understand it, and to come back if you have any questions with us. But at that point, Diana, I will hand back to you, and thank you all very much for listening.
Thank you, Tom, and thank you, Luka.
Thank you, Tom.
I know for members tuning in, please feel free to ask any questions in the chat function. See, we don't have any questions yet, but now's the opportunity to put those in there. So we'll give everyone just a couple of minutes. Maybe I could ask Tom, since you conducted some of these one-on-one in-person interviews, or not in person, but virtual interviews, hopefully in person at some point.
Yeah.
Was there anything that struck you in conducting these kind of in-depth conversations with the respondents?
Yeah, it was a really interesting one. I guess from the corporate perspective, I think it was just around what struck me was, and maybe because I've been focused so much on doing this research, you know, how sort of quickly the deadline is looming. But whilst they said things like Brexit and COVID were more important, that's not to say that Libor cessation isn't. And I think that's an important context, and a point that we do make in the report is, just because it's less important than COVID and Brexit doesn't mean it's not important. I think that was the thing that came through, and I think with regards to the sort of the contact that they've had with banks, I think it's just a case of wanting more of it. You know, the contact that they do have when they have it is very good. But like Luka and yourself have pointed out across the presentation, it's not easy for the banks, and it's not even easy for the associations whose job it is to focus specifically on these sorts of things, and you know, Luka's position from a legal perspective. So I think that is a really important point to make, that yes, there were frustrations from the corporates, but like Luka said, a lot of progress has been made. There's still some way to go, and there are still challenges to go, and hopefully these sorts of conversations, this report, this presentation, will bring it more into focus for corporates, particularly in trade finance. But yeah, we're moving in the right direction. I think it's just how quickly we move from this point until the end. Now, whether or not we're in the same position, you know, December the 29th, it remains to be seen. And I think the other point to make is with the June 30th, 2023 date, it remains to be seen how much of an impact that will happen, and if that will cause a delay to things because people think they've got a bit of a buffer.
Yeah, good point. And certainly we've interpreted to mean that kind of that extension of publication of USD LIBOR until June 2023 does not apply for any new issuance. So really the group has been working towards how do we prepare for end of the year, and in some cases even sooner, best practice of having the transition in place by this summer. So we will see some first mover financial institutions who will already begin transitioning kind of some of their new business to, whether it's an alternative to a SOFR term rate, say the BSBY, or some other rate, and we'll look to kind of drive the market in that direction. And we've also seen some smaller US regional banks who have opted to use other rates, say Ameribor. They've already made those kind of those public statements that they will be transitioning to that rate. I will say one thing that I noted, and you know, nothing is complete until it's complete. Similar to in the Sonia case, where recently we commented on kind of the use case of term Sonia and whether trade finance, which was an eligible use case. I think it was in addition to Islamic trade. There'll need to be a similar outreach effort with the ARC to ensure that when and if they recommend and approve use of the CME term SOFR rate, that trade finance is equally identified as an eligible use case, which we expect to happen, but advocacy must continue to ensure that is the case.
No, absolutely. And I think the point that you just mentioned about, you know, there are other rates that people can use, and Luka, perhaps a question for you here, like particularly in export finance, they've got access to like the SIR rate, for example. And with SIR so low at the moment, that is, I mean, from our other research that we're doing, there is a huge appetite for borrowers to access direct lending from ECAs. Luka, I get something that, you know, from you, you know, in the position you operate, I mean, is this something that you're seeing? And, you know, what are your reflections on the SIR rate compared to, say, something else, you know, other floating rates or fixed rates?
Yeah, thanks, Tom. It's a very good observation. We at Baker McKenzie have quite a big trade and export finance practice, and we do a lot of work with banks and EC and export credit agencies. What we are seeing is you know, export credit agencies using their SIR sort of funding ability, and then sort of delivering that through more direct lending type products, rather than sort of looking at a kind of covered or insured type of product. And as you said, Tom, I mean, the SIR rate is sort of remarkably low at the moment, and what we are seeing in the market is a lot of loans being documented using the SIR rate, because a number of ECAs have an unlimited capacity to tap or to use the SIR rate. And then the other one is quite the simplest of fixes, is to denominate your term loans into euros and use Euribor as your fallback, because, or sort of as your floating rate, and there is currently no real plan to discontinue Euribor, although there are working groups in place that are looking at a discontinuation, or at the very least, if Euribor was not available, what would our fallback be? And I think it's Esther is being looked at as hopefully providing a term rate, again, for trade finance. But for those on the call today, it is pretty safe to say that at this point of time there is no plan for a Euribor discontinuation.
Mm-hmm. Hopefully encouraging news to a lot of people, hopefully, maybe.
So I know we just have a couple of minutes. I want to remind those tuning in that if you still have a pressing question and would like to ask it now, feel free to type it in the chat box. Otherwise, you have our contact information. I think we'd all be happy to field any questions on this survey or on the content. Just to summarize, maybe wanted to touch on a couple of points that certainly this presentation, because it's on demand, if there are other colleagues who want to watch it, it should be made available on the conference website within 24 hours. The report, which is drafted, should be published within the next, early next week or sometime next week. So that should be made available, I believe, on all three of our platforms, and we will be sure to get it out to participants of the conference. Will be on our website. And certainly many thanks to the support to both of my colleagues on the panel for putting together the survey, conducting the interviews, and kind of being leaders on this front. And from the BAFT perspective, I think we too will be publishing some content of frequently asked question documents. We've thrown out kind of many acronyms for different rates. Timelines are different across different currencies. Things are quickly moving. So our FAQ will address what we know as of date of publication and look to update that as the cessation of LIBOR moves forward. And I think perhaps most important and something that people will want to take a look at is the comparison between the CME term SOFR and the other alternatives to that term rate to really evaluate what might make the most sense. And we also kind of prepare what's ready to go for people to consider. So I think with the last 2 minutes that we have, any final comments? Perhaps I can turn to you first, Luka.
And well, just to say that we look forward to working with you, BAFT, and obviously Tom at TXF to further exploring this, the discontinuation of LIBOR and the fallback rates. And thank you everyone for listening. It was a pleasure being part of the panel. Thank you.
Thanks, Luka. Tom?
No, well said, well said. It's been a pleasure. So if anyone has any contact or any information or would like to know any more about this or about the report, please do get in contact with any of us. And yeah, the report will be out very soon. Thank you.
Wonderful. Well, thank you both. And thank you all for tuning in either late in the evening, early in the morning, or sometime in between. Always a good time to talk about LIBOR cessation. So looking forward to continue the conversation. Enjoy the rest of your day.